If you live and work in Canada, there is a very good chance you are paying more tax than you legally have to. Not because you are doing anything wrong, but because the Canadian tax system has rules built into it that actively reward people who know how to use them. And most people simply were never taught what those rules are. Today, we are going to fix that. We are going to go through 5 tax rules that most Canadians are either ignoring completely or using incorrectly. And by the end of this video, you will have a concrete list of things you can act on before the end of this year. Before we get into it, I want to be clear about what this video is and what it is not. This is not about tax evasion. Everything we are covering today is completely legal, CRA-approved, and built directly into the Canadian tax code. The government created these rules on purpose. The only question is whether you know about them and whether you are using them. Most Canadians are not, and that is costing them real money every single year. Rule number 1 is one of the most overlooked and most valuable. Maximizing your TFSA with the right assets. Most Canadians know they have a TFSA. Most Canadians are not using it correctly. The TFSA is not a savings account. It is a tax-free investment account, and the distinction matters enormously. If you are holding cash or a low-interest savings deposit inside your TFSA, you are wasting the most powerful tax shelter the Canadian government has ever created. Every dollar of growth inside a TFSA is completely tax-free forever. That means capital gains, dividends, and interest income generated inside your TFSA will never be taxed, no matter how large they grow. The strategic implication of that is straightforward. Your highest growth, highest return assets belong inside your TFSA. If you hold a globally diversified equity ETF inside your TFSA and it grows from $50,000 to $200,000 over 20 years, you owe CRA exactly $0 on that $150,000 gain. If that same investment sits in a non-registered account, you will owe tax on every dollar of growth at your marginal rate. For 2026, the cumulative TFSA contribution room for someone who has been eligible since 2009 is $102,000. If you have never contributed or have significant unused room, this is the single highest leverage move available to most Canadians, and it costs you nothing except the decision to use it properly. Rule number 2 is the RRSP deduction, and specifically the timing of when you use it. Most people know that RRSP contributions reduce your taxable income. What most people get wrong is when to make that contribution and which year to claim it in. Here is something CRA allows that most Canadians do not know. You can make an RRSP contribution and choose not to claim the deduction in the same tax year. You can carry that deduction forward and apply it in a future year when your income is higher. This matters because the RRSP deduction is worth more when it offsets income tax at a higher marginal rate. If you expect a significant raise, a bonus, or a high income year coming up, it can make more financial sense to hold your RRSP deduction and deploy it when it saves you more. This is not complicated to do. It simply requires you to think one step ahead rather than defaulting to claiming everything immediately. Rule number 3 is capital gains timing, and this one catches a lot of Canadians off guard when they finally have non-registered investments. In Canada, only 50% of capital gains are included in your taxable income as of the current inclusion rate. That is actually a significant advantage compared to how employment income is taxed, but it only helps you if you are thoughtful about when you trigger those gains. If you are planning to sell an investment that has appreciated significantly, the year in which you sell matters. If you are retiring, taking parental leave, or expect a low-income year for any reason, triggering capital gains in that year means the taxable portion gets stacked on top of a much lower income base, potentially keeping you in a lower marginal bracket. Conversely, selling in a year where you have already earned significant employment income means that capital gain gets taxed at your highest marginal rate. The investment itself does not change. The timing does, and the timing is entirely within your control. Rule number 4 is income splitting, and it is one of the most underused strategies available to Canadian couples. The Canadian tax system is structured around individuals, not households. That means if one partner earns significantly more than the other, the higher earner is paying tax at a much higher marginal rate than necessary on a household basis. The spousal RRSP is the most accessible tool to address this. The higher income spouse contributes to an RRSP registered in the lower income spouse's name. The contributor gets the deduction at their higher marginal rate. The lower income spouse eventually withdraws the funds at their lower marginal rate. The household pays less total tax. This is entirely legal and specifically designed into the tax code for this purpose. There are attribution rules to be aware of, specifically a 3-year window before withdrawals are taxed in the contributor's hands rather than the account holder's. But beyond that window, the strategy works exactly as intended, and the tax savings over a career can be substantial. Rule number 5 is one that fewer people know about, and almost nobody under 40 is using yet. And that is the First Home Savings Account, or FHSA. If you are a Canadian resident, at least 18 years old, and you have not owned a home in the current year or the preceding 4 calendar years, you are eligible. The FHSA gives you up to $8,000 per year in contribution room, up to a lifetime maximum of $40,000. Contributions are tax deductible, exactly like an RRSP. Growth inside the account is tax-free, exactly like a TFSA. And withdrawals for a qualifying home purchase are completely tax-free as well. That means the FHSA is the only account in the Canadian tax system that gives you a deduction on the way in and tax-free treatment on the way out. Every other registered account makes you choose one or the other. The FHSA gives you both. Here is the part most people miss. You do not need to be actively planning to buy a home right now to benefit from opening an FHSA. Contribution room only starts accumulating after the account is open. If you open the account today and decide in 3 years that you are not buying a home, you can transfer the balance to your RRSP with no tax consequences and no impact on your RRSP contribution room. You lose nothing. But if you wait 3 years to open it, you have permanently lost 3 years of contribution room at $8,000 per year. That is $24,000 of tax-sheltered space that you can never get back. If you are eligible and you have not opened an FHSA yet, open one this week. It is the highest certainty, lowest effort tax move available to a significant portion of Canadians right now. So let's bring this together. 5 rules, all legal, all CRA approved, all available to you right now. First, put your highest growth investments inside your TFSA and stop using it as a savings account. Second, consider carrying forward your RRSP deduction to a higher income year rather than claiming it automatically. Third, time your capital gains strategically by selling appreciated investments in lower income years where possible. Fourth, use a spousal RRSP if you and your partner have meaningfully different incomes. And fifth, open an FHSA immediately if you are eligible, even if you are not sure you will use it for a home purchase. None of these strategies require a financial advisor, a tax lawyer, or a complicated investment product. They require knowing the rules and making deliberate decisions. The Canadian tax system rewards people who pay attention. Most people are not paying attention, and the cost of that over a lifetime of working and investing is significant. If this video helped you, the next one to watch is our breakdown of the 5 biggest TFSA mistakes Canadians make, linked right here. Subscribe for more evidence-based Canadian personal finance, and I will see you in the next one.